Boom! Welcome back, everybody. It is your host, Ben Suttles and Ferris Musa.
Monday, January.
Whoa! Hey, Saturday, man.
It's been a long day. It's been a long day.
It is Monday, my friend. We are back. Money Mondays, folks. We do this every week at 3:30-ish Central Standard. So check it out. What are we talking about today, my friend?
Talking about how to structure multifamily investment deals. There's a lot of ways to structure them, and ultimately, investors will invest in a deal they think they can make money. And as an operator, you want to structure it effectively. I like to say multifamily is the art of financial engineering. So we'll get
cap stack, right? So your capital stack, folks, as you know, right, is what amount of debt versus what amount of equity versus what amount of pref equity that you might have in order to obviously make the deal the most profitable that you can get it, right? So we're going to hop right into this. We have some questions kind of queued up. So, what are some of the different structures of a multifamily deal, right? You can do different splits. You can do different waterfalls. You can do preferred returns and pref equity. You can do a lot of different things. In fact, you can carve up a deal 1,000 different ways, right? So let's just talk about maybe least complicated to more complicated, because I'd say you can probably get very, very mundane and simple to extremely complex, but we're going to kind of stay in the middle. All right, so just stay with me, right? So you got 100% of the deal. The most simplistic way that I've seen it is call it a 70-30 split. So 70% of the deal and the profits that come from that deal go to your investors, sometimes called LPs, sometimes called members. Then 30% of that deal is going to go to the GPs, which are the syndicators or the people putting together the deal, and sometimes referred to as the managers. It's a straight split. So if you make $100,000 in a year, $70,000 goes to your investors, $30,000 goes to the GPs or the syndicators, right? Very vanilla, right? People can kind of get that, right? Now you can get a little bit more complicated. Now let's say that you want to have a preferred return, right? And people are like, what the heck is a preferred return? Well, it's essentially a return that is paid first before any splits happen, right? And let's just keep it simplistic, right? Let's say it's a 7% preferred return. You pay that typically on the amount of money that you raise, right? So let's use round numbers. $1 million, it's a 7% preferred return. That means the first $70,000 that you make from this deal is going to go to your LPs to pay the preferred return.
So as an LP, should I like a preferred return or should I not, and why?
I actually do. We're LPs too on a lot of deals and just deals in general, right? We actually like the preferred return, right? Because it means that the first dollars that come out of that investment actually go back to our investors, right? And then from there's a split. So everybody's very, very incentivized to get above and beyond the preferred return, right? So I like it, right? Some people are like, it's too complicated. I just like a straight split. That's fine. There's arguments on both sides of it, right? But that's what a preferred return is, folks. So that same example that I used earlier of $100,000, remember that first $70,000 is going to your LPs, right? Your investors. So of that $30,000 that's left, now you're splitting that 70-30, right? And I'm not that good at math, so I'm not going to try to do what that number is, but you can do it on your calculators. You can determine what that is. So obviously a lot more advantageous for your investors.
Absolutely.
Right?
So again, as an investor, understand the structure. It's important to understand where money flows, and that's where one of the first things I actually flip to in any operating agreement is what it says for distribution or breakdown of distributions and sales.
Yes.
So on a sale,
that might be the most important part. That actually might be the most important part of the PPM. And people are like, I don't want to read it or I don't understand it. Right? Find those two sections. That tells you how you get paid.
Who gets paid, when,
yes.
What burdens on the capital stack and what doesn't. So.
And you need to understand that, right? If you're going to invest with somebody, find those sections. If those sections are unclear, get the syndicator on the phone and say, I want you to walk me through this. How do I get paid? When do I get paid? Who gets paid before me? Who gets paid after me? Right? You need to understand these things. So that's the reason why we always tell people to read the documents that you sign. It's very, very important. Right? Now, I'm going to get into a little bit more of a complicating factor, right? Let's talk about waterfalls. There's a lot of this terminology that kind of goes in there, right? So you can do a waterfall on a lot of different things, but we're gonna base it on returns and we're gonna base it on IRR. Right? So in some circumstances, right, let's say it's a 70-30 split up to a 20 IRR. Now, most days, workforce housing stuff, you're not going to get 20 IRR anymore. But let's just, for example purposes, let's use that number, right? It's a 70-30 split until you hit a 20 IRR. After the 20 IRR is hit and above that, it then goes to, say, a 50-50 split, right? So that means that any returns above a 20% IRR are split 50-50 between the GP and the LPs. Anything below 20% IRR is split 70-30, right? And I've seen it different ways. I've seen it where, you can do a straight preferred return and everything above that's 50-50, right?
Question, why do they call it a waterfall?
Right, because it's essentially the more money that you make, right, the higher the return is going to almost promote it. Well,
yeah,
okay.
It's the trickle down of money.
It really is the trickle down of money. I'm trying to
step ladder.
I'm trying to explain it from the sequence of a GP, but really you have to kind of look at it from the LP's perspective, right? The more money that the deal makes, the more money the GP is going to make, right? And that doesn't necessarily mean that it's a bad thing, right? Because all the returns that the GPs or the syndicators are giving to you should all be net of all of the waterfalls anyway. Right? So you just need to look at it from that perspective. Now, one last thing, right? And I'm not going to get into mezzanine debt. There's some other things, but preferred equity is a thing these days, right? And let's talk about preferred equity because that seems to be, a lot of people just don't understand it.
I know that it's different than preferred return.
It is definitely different than preferred return. So take preferred return out of it, right? So this, and it's also called preferred equity and pref equity, right? So you're going to have your senior lender, right? Your cap stack, right? Or they could be down here. It doesn't really fucking matter. Excuse me. Freaking matter.
Jeez,
I know.
We can't
it's Monday. It's a Monday. I know. They can bleep that out. We are live though. So anyway, so they own, call it 70% of the deal, right? Then you're going to have your common equity. No, excuse me. Then you're going to have your pref equity of 10%, and then your common equity of 20%. Right? As you can see, your pref equity is right up against your senior lender. So what ends up happening, right? They're actually going to be the first ones that are going to get paid, right? After the senior lender and before the common equity. And they're going to be the first ones that are going to get paid back, right after the senior lender and before your common equity. So what the hell does all that mean?
So question, what's the difference between pref equity and mezzanine debt?
Well, okay, so pref equity, you do get part of the upside, and you're able to.
It depends. It's really the.
Well, so it depends.
Lean, right?
Yeah, it depends.
That's the main thing.
And I guess you could get part of it. You could get some of the upside. Just depends on how you structure it, right? Most of the time, it's just a straight preferred.
But it's usually the lien, right? If you default, the senior lender's first lien, then
you're talking about the mezzanine. Yeah, the mezz. Yeah, so you're talking about mezz.
So pref equity is just like a second note. It's really no different, except for there's no lien. They are participating in the deal. If the deal defaults, they are at risk because they're sitting behind a senior.
And sometimes they can get depreciation. Yeah, there's some other reasons why it's different than debt,
it's
right?
Really, it's a lot like debt. They are getting paid first, just like your lender gets paid first. So whatever's left over is paid out elsewhere. So that's all you need to know.
Well, and the other thing that you need to know too, right, is it's essentially going to take away cash flow from the deal to juice the IRR. Right? Because essentially what's end up happening is that first chunk of money, typically they're going to get a straight 10% return on that pref equity money, right? Well, where's that additional money coming from? That 10%, that seems pretty high for right now, right? Well, it is. They're taking that from the common equity and they're giving it to these guys, but then they're juicing the overall deal's IRR, right? Again, look this up, folks. There's a lot of information on this. I think we probably have some additional blogs and some other stuff to talk about this. But bottom line, and this is just another way to financially engineer your deal these days, right? And it also helps certain syndicators raise additional money where they weren't able to do that through common equity. They have to layer it with pref, right? So those are some of the different structures that you have. As you can see, those are just like the four most common ones. There's 1,000 different ways to carve it up. Right? So check that out. That's really, really important because the way that you do this is going to maximize the profitability on the deal, right? All right. So what are some of the red flags that people should look out for on deal structures?
I mean, just look at how the money is distributed, right? That's probably the biggest one, I would say. Just understand how money is moving and is it return of capital or return on capital. Two-letter word means something very different. It's not that that's right or wrong. It really depends on what your goals are and what are the goals of the business plan. There's a reason to do one or the other. I think that's one of the big ones.
Yep.
I'd say the other one too is just again understanding the business plan. Right, there is something called risk-adjusted returns. You need to understand what risk-adjusted returns. If I have two deals in front of me, both of them are going to give me a 14% IRR. Right, well, I want to naturally go find the one that is lower risk.
Yes.
That could mean it doesn't need any value add, no upgrades needed. It could mean that it's a better location. It could be better tenant demographics, right? The whole shebang.
Yep.
And so I think that's another one is just not all deals are created equally. And I think too many operators position them like they're created equally, and too many investors interpret them like they're created.
No, I would say, yeah, and we've seen both that. I mean, we know, we won't name any names, but there's a shop out there that everything is like 17, 18% IRR. Doesn't matter if it's a Class A, Class B, or Class C deal. Well, guess what? First of all, I'd still say I'm pretty skeptical of those IRRs these days. But also, let's be honest, right? If those are actually true, right? Let's just say that they are. That's a big if, right? I would much rather go with a Class A deal that gives me 18% IRR than the Class C workforce housing deal that I have to put $3 or $4 million into, right? Why is that? It's because there's a lot more risk, execution risk in the workforce housing deal, right? Let's be honest, folks. $3 or $4 million in capex. You got to reposition the property. It's probably going to be in an inferior location in a city that you're in. I would much rather go with the Class A deal. A lot less risk involved, right? So those are some of the red flags you got to be looking out for. But I mean, again, all of this should be disclosed in the PPM, so you have to read it, right? Ask questions. What is the legal entity used to structure multifamily deals? Again, it could be you could have a lot of different legal entities. We typically have an LLC, which we sell shares of. Right, and each share is $1,000, and typically the minimum is $75,000. So you're buying 75 shares of that LLC. That is what we're doing when we're talking about syndication. I am selling you part of this partnership, right? And then you're giving me your money that I'm then using to put as a down payment on this property, right? But then because you're a partner in an LLC now, you get the K1, you get losses, you get the gains, the whole entire shebang, right? But typically you're going to get an LLC that's going to hold, the property in it, and you're going to sell shares of that, right?
Absolutely. Not like our recent deals where we have 15 LLCs in the same property.
Well, that's a whole other story. So what are equity splits and what are common equity splits? I'd say we talked about this earlier, right? Typically 70-30.
Depends on if you have a pref or not.
Yeah,
right? How
mean,
much meat on the bone. There's a lot of reasons these things should change, but market today is 70-30 with a 7 pref.
Yes. Boom. All right. So what is the most efficient way to raise private equity from investors? This one's a tough one. I think that, ultimately
one person at a time.
Yeah, well, you don't want to do that. You ultimately want to have an engaged audience, right? As you're watching this show, right, this is one of a marketing channel that we use to get people to reach out to us that might maybe want to potentially invest, want to partner, maybe they're a vendor or want to be a potential vendor. You want to have an engaged audience on your list. Then you want to market to that list. And so when you have a deal, you want to send the deal out. And hopefully you have enough people that are engaged and excited about you having a deal and want to invest in you and want to invest in your projects, that once you have something and you send it out, people are going to reach out and say, hey, I'm interested, right? And there's a lot of other ways to do it. If you've got a big social media, following, monetizing that, just like Grant Cardone. Think of Grant Cardone. He had a great following. He's got an even bigger following now, but he monetized that following to go buy a bunch of real estate, and multifamily in particular. So, so it's always nice to not have to go out and hunt. It's nice to have the things just come straight to you, right? All right. So what is a preferred rate of return and how does it work? We talked about that one. What are the most common sponsor fees you'll see in a syndication deal? All right. Again, you can carve it up 1,000 different ways. Typically, you're going to have an acquisition fee, which is a function of how much the purchase price is, and you're going to see anywhere from.
You should look into that, 'cause some people do it on capital as well.
You could do it, you could do it on the capital raise or the purchase price, are typically the most common ways to do it. We do it on the purchase price, and it's typically anywhere from 1% to 3%. We've seen it as high as 5%. We don't really necessarily go down that route, but those are other people that do that. You have asset management fees, which are typically based on the amount of total income that the property takes in each month. And it's a percentage of that. And again, anywhere from 1% to 3%. We've seen it as high as 5%. Property management fees, more of an operating expense, but since we have our own management company, we also have those as well. Typically, ours are going to be anywhere from 3 to 4%, right? Just depends on the size of the deal and everything else. You can have a capital transaction fee, which is typically on a refinance, and then you can have a disposition fee, which is on a sale. Right, and I'd say those are
capital transaction fee usually encompasses the disposition and the refi. That's the difference. Yeah, so just kind of get that little nuance.
Yeah, and we've seen guarantee fees. I mean, there's other stuff. Guarantor, like you're a guarantor.
Asset management.
Yeah, so I mean, there's a lot of different fees out there. Those are probably the most common. And then again, you're going to see a lot of this stuff. It should be disclosed in your PPM. So check that.
It needs to be.
It needs to be, actually. Sorry. Yeah. And if it's not clear or you're not 100% sure, ask the sponsor. The sponsor should be able to tell you. All right.
That said, if people have comments, questions, thoughts, please ask them. We'll answer them live here on Money Mondays.
Oh, my gosh. We got to start a little late today. I don't know if we got any questions.
I don't know. It's kind of quiet today, even though we have more viewers than usual. So structuring is not as exciting and sexy as it used to be back in my days. So.
No, and again, folks, you can carve it up 1,000 different ways. We've seen people structure as debt, right? We have guys that just, it's a straight up 8%. That's all they get. They don't get any upside. And some of their investors are happy about that. We couldn't believe that somebody could actually raise money doing it that way, and he's killing it.
Absolutely.
So, again, it's all in the eye of the beholder. It's what your investors will accept. So, oh my gosh, this is coming up, man.
It's coming on up. Not this weekend, but next weekend. We have our big conference coming up. And, we're already sold out of VIP tickets, and we're on track to sell out of the regular tickets. So if you're interested, go check it out. Multifamily Investor Network. Where, Ben?
mfinvestornetwork.com.
What city?
Oh, it's in Houston, dude.
Houston. Here in Houston, in our backyard.
Come on.
700 people here at the Omni in the Galleria. It should be a great time. Good quality event.
Yeah.
Good quality speakers. Good quality content. And plus, we're going to be there so you get the hang
Oh, my gosh. So, yeah, use coupon code LAST CALL, folks, here in Houston. Not this Saturday, but the next Saturday. Going to have about 600 or 700 of our friends. A lot of great content. Most importantly, a lot of opportunities to network and just get to meet your next partner, investor, vendor. You're going to have a lot of opportunities to do some networking. So check that out.
So definitely love to see you there. Come up, come check it out. Come say hi to us.
All right. Oh,
and what are we doing after that? The day after
we're doing the property tour. So that should be fun.
Recent acquisition. So
yep.
Come check it out. We will go out to the property we bought, talk about what we're doing for the CapEx, talk about the good, the bad, the ugly. Go see what these properties look like, what they feel like, what they smell like. So go check it out.
Hopefully it smells good.
It's one of our newer deals. So
hopefully it smells good. But yeah, reserve your spot. We got limited spots on this one, folks. So, if you are interested in coming out, reach out to us. It's on Eventbrite, but it's a multifamily property tour the next day after our conference.
All right. And the last but not least, what else do we have going on this week?
We got a lot of stuff going on, man. Multifamily real estate investing open Q&A with yours truly, Ben Suttles.
Not me. Sorry, guys.
Yes. So I will be out there answering questions. This guy will be at NMHC. Probably having way too good of a time. I'm actually back here working, doing some stuff.
Yeah, I'm sure.
But we'll be out there.
Speed dating in Vegas with the brokers. Am I right?
Wakefield Crowbar this Thursday, 7 p.m., February 2nd, right here in Houston. Check it out. www.disruptequity.com/HTX Meetup. All right. So what's coming up next? Oh, my gosh. We got to put the title there. What are we talking about?
Raising money for deals in uncertain times.
All right, we're raising money. All right, which we love to do.
Certain times.
We raised 9 figures last year, folks, so we know a little bit about that. But if you'd like to hear a topic, please reach out to us, drop it in the comments, give us a heart, give us a like. Please share this. We love doing Money Mondays. We want to continue to add value. But we will be seeing you guys next week.
All right, thank you very much.